I'm not sure where you want to begin with this, but there's no living soul who believes we've only been through 23% inflation over 4 years.
It's
That's
absurd.
It's absurd. You're looking at 19% interest inflation rates in 2023. And that's just one piece of it, right? I mean, the CPI doesn't include cost of homes, as incredible as that sounds. Instead, they just look at homeowners equivalent rent. And that is an inflationary problem. Housing insurance is not included in the CPI. Car insurance is not included in the CPI. Health insurance is included in the CPI. This is also why the CPI is not really fitting with any individual sector within the PPI. PPI is still roaring ahead. I'll tell you what's most profoundly affected by this is GDP. So keep in mind, GDP is supposed to be the measure we use to consider output. Output is the term we use to discern where we are in the business cycle. Are we in recovery or are we in a recession? It looks to me as if we have not ever recovered from March 2020, that we might be in the equivalent of a Great Depression now, and it's just being cast as recovery. So,
is it incompetence or is it nefarious as far as calculation and data? Today, again, I say this all the time, and you guys got to start believing me. You can think that the two of us are full of shit, but you can't deny the fact that we get outstanding guests, and today we have another one. We have Jeffrey Tucker, president of the Brownstone Institute, and one of my favorite follows on Twitter. Thank you so much for being here, Jeffrey.
It's such a pleasure. Thank you. What are we talking about today?
That's your job to tell us what to talk about. Normally, 60 or 70% of our shows are geared towards finance professionals, economists, traders.
Look, I have a big new article that just came out like 10 minutes ago.
That's what I was just about to talk about. Let me act like I was prepared. It's about authoritarianism. I love the
No. It's even more new than that. It's called "Are We in an Inflationary Depression?"
Perfect. Let's talk about that. Are we in an inflationary depression?
So, and the point of the article is to examine all known data and raise questions about all of it. Like, none of it really makes sense. Once you start to deconstruct it, it's quite alarming. And I'm not sure where you want to begin with this, but there's no living soul who believes we've only been through 23% inflation over 4 years.
It's absurd.
It's absurd. But once you start to examine this, to try to come up with the correct number, you get into real problems because we don't actually know what the right answer is. Once you add in interest charges, for example, you're looking at 18%, 19% interest inflation rates in 2023. And that's just one piece of it, right? I mean, the CPI doesn't include cost of homes, as incredible as that sounds. Instead, they just look at homeowners equivalent rent. And that is an inflationary problem that's beyond belief. I ran some charts. It's absolutely shocking what's happened to the price of homes. Then, you've got to consider shrinkflation here, which, I mean, I'm sorry, but the Bureau of Labor Statistics does not do a good job tracking shrinkflation, nor do they track fees. So if you could just, the goal of every merchant now is to hide the higher prices in strange fees. You order a beer and you have to pay a mug cleaning fee or whatever. It could be anything. And these fees are eating us alive. The other things get very strange, like the housing insurance is not included in the CPI. Car insurance is not included in the CPI. Health insurance is included in the CPI, but it's calculated against health consumption. So if you're paying, you could be paying 2-3 times higher premiums, but if you're consuming more in the way of medical services, then it counts against those premiums. So you can have a 50% increase in health insurance being rendered as a 50% decrease in the CPI. And of course, it doesn't look at taxes. And, there's a lot of places in this country where you're taxed for everything. Like, you can't own a vehicle in the city without the tax, and they send you the bill. And you're like, well, that's double last year. But what are you going to do? Not pay it? Or move? ditch your car in the river, you'd probably be charged a disposal fee in that case. So there's no getting around. So once you start adding all this stuff up, it's very possible we're looking at declines and purchasing power of the dollar that over 4 years that are closer to 40%, 50%, maybe even as high as 75%, depending on the sector. This is also why the CPI is not really fitting with any individual sector within the PPI. PPI is still roaring ahead. CPI is somehow now at 3.3. It's not believable. But then it gets even crazier once you start examining things like, one of the things that I'm so intrigued by is retail sales and factory orders. Now, these are typically calculated not based on how many hamburgers you sold, but how much you paid for them. So that's how retail sales are calculated. So if you paid $10 for a hamburger last week and you're paying $15 for the hamburger this week, that is seen as a 50% increase in hamburger sales, even though you're just buying another hamburger. So how are you going to adjust this? Well, you have to adjust retail sales by inflation. Once you do, what you see is that we've had falling retail sales and factory orders for the better part of 4 years. But here's the other thing: how far have they fallen? You don't know, because we don't know the inflation rate.
So can I interject something really quick about inflation too? I own a restaurant in the suburbs of Palatine, and the notion that our costs had gone up 25% like they told us they have is completely absurd. They've gone up a lot closer to 50%. And climbing. Many of them, wages and things like that have to follow as well. So it's good. I didn't mean to interrupt you, but
no, not at all. That point. I mean, it's very important, and this inflation data affects everything else. And I'll tell you what's most profoundly affected by this is GDP. So keep in mind, GDP is supposed to be the measure we use to consider output. Output is the term we use to discern where we are in the business cycle. Are we in recovery? Or are we in a recession? But even now, everybody knows not to look at nominal GDP. You have to look at real GDP to find out. Real GDP is calculated by measuring nominal output against what's called the GDP deflator, which uses a thing called the personal consumption PCE, whatever that to calculate it, which PCE data is much lower than CPI. So now, and just hold that thought and consider too that output goes up with government spending and government increase of debt. That's considered to be productivity. All right. Once you take out government spending and take out government debt and then adjust those figures by a realistic measure of inflation, which, let's say over 4 years, it's been 35 to 50% to 60%, depending on how you want to do it. It looks to me as if we have not ever recovered from March 2020, that we might be in the equivalent of a Great Depression now, and it's just being cast as recovery. And there's a lot of evidence to suggest that's true. Once you look at the jobs numbers, there's a vast gap that separates the establishment survey from the household survey, and that gap is increasing. And the establishment survey tends to double count. So if you fire a full-time worker and hire 2 part-time workers, that's a job creation of 2 jobs. You call up the household and the guy's like, I don't know, I used to have a full-time job and I got 2 part-time jobs. That counts as 1 job. That's why the disparity between the establishment numbers and the household numbers. So,
is it incompetence or is it nefarious? As far as calculation and data?
Well, it's both, right? So they don't have the capacity to gather all the data that's necessary to read what's really going on in the macroeconomy. It's not possible.
No, Mike, my wife got in a car accident. I got to run. I just got a text that they're checking her out in an ambulance about a mile from the house. I'm so sorry, Jeff.
Based on what you and Jimmy talked about a few minutes ago, from a perspective of PCE, you mentioned PCE, the personal consumption expenditures.
That's what I was looking for, expenditures.
Yeah. Right. So CPI, I think, is generally accepted with sort of critical thinking people as being just complete crap. Yeah. Right? Overall, it just doesn't measure things correctly. That homeowner's equivalent rent has been like a sort of a laughing stock of the price of homes for a long, long time.
Sure.
And by that, I mean like 8 months, because everything is small cycles now. But the PCE, the Fed tends to say that that's the one they look at. And
Yeah.
when you look at least the way like an Investopedia or even ChatGPT defines it, even they describe it as more reliable. So where's the flaw in that? You mentioned that it includes government debt.
Well, that's GDP. The PCE, I don't know what the problem. I don't know how they calculate PCE. The only reason I'm
Because it's
saying it's
lower
less,
than CPI, right?
the only reason I'm concluding that it's not as good is that it's just so much lower. I mean, it's just
Yeah.
been consistently lower, and I just don't believe it. Like, if you don't believe CPI, you really can't believe PCE. You know what I mean? So, and to use PCE to adjust for an already wildly distorted GDP is what's interesting about all this stuff is that so often what we think we know is determined by the data we're receiving. And it could be retail sales, wholesale, or factory orders. Could be GDP, could be inflation, could be the jobs data. Whatever we're looking at, those are all the main ones I like to look at. None of them fit at all. Well, first of all, once you unpack them, they all kind of are discredited. So what we think we know may not be true, in fact, at all. That's the possibility I'm raising. The other thing that my article does, which I co-wrote with Peter St. Ange, it overlays this with consumer sentiment surveys, which are catastrophic. I mean, we've not anywhere near recovered from March 2020, where it just
Right.
plummeted down, and it's not recovered, and it's falling again. So the question is, like, well, who are you going to believe, the statisticians or your own eyes? You know, I mean, the University of Michigan does these consumer sentiment, and all they're doing is reporting what people say.
Yeah.
And I tend to think of that's going to be a more accurate reading, but it's a very strange possibility that we could be in a very high inflationary economic depression right now and not know it. That to me is a very interesting possibility.
So here's a strange thing, and this is something that I have huge problems with Paul Krugman because he's been doing this for years and years, where he basically, I'm going to paraphrase what he said over, let's say, the last 3 years. It's not as bad as you feel it is. That's something he seems to be repeating over and over again in the New York Times and elsewhere. You people say that this is really bad, but the data is not showing that. There's other people, influencers, like Kyla Scanlon, for example. I like her a lot. But I see her every once in a while, and I hope she reaches out if I'm misrepresenting the way she thinks, saying things like people need to understand the data better and then they won't think things are wrong. I've always maintained that, you could say we're in a recession or not, it doesn't really matter. What you're living is what matters.
Right.
So do you think it's actually important I'm a strategist, not an economist, right? So I tell people all the time, it's not my job to say what's right or wrong. It's my job to figure out what the markets are going to do versus the data we get. Are we China in terms of data?
Right. And by the way, this is not anything I've really thought about until recent years. And it was, you could make a case that 10 years ago, CPI was overestimating inflation. I mean, I'm not sure about that, but you could, because it wasn't sufficiently adjusting for, doing hedonic adjustments or, whatever the hell. But that is no longer true. And the thing that started making me question everything was the jobs data. You can't look at the jobs data and go, oh, okay, there's 212,000 jobs that were created last month, and look at chart B and see that actually we lost 150,000 jobs. So, like, both can't be true. So I began to look at it, and the thing that really started to bug me were the retail sales numbers. Where everyone's, retail sales are up, it's great. And then once you realize that these are just straight up dollar figures, you realize people are not buying more stuff; they're just spending more on the same stuff they used to buy, and by how much? And that raises the question of the inflation rate itself. And once you realize that inflation rate doesn't consider homeowners insurance, which is it's out of control to the point that but the people are actually anecdotal evidence that people are actually selling their homes because they can't afford the insurance to insure them anymore. Why are the insurance rates going up? Well, because it costs too much to repair and replace homes today, and the actuaries get busy and go, okay, if a tree falls in this house, or if the kid burns down the house, or whatever, what's it gonna cost us to to respond to insure this house and relative to what the premiums have to be. And so the actuaries are just delivering the bad news. And the thing is through the roof, and people can't afford to do it anymore. So they're dumping. And that's why a lot of the houses that are being sold on the market right now are being sold for cash. People are buying it because if it's a cash offer, they don't have to insure it. Okay, so that makes sense, but that's subsidizing, all these cutouts for state, for BlackRock and Fidelity and all these things that are just flipping these homes for purposes of either making a profit or renting them out. So it starts to get super creepy when you consider that, and then car insurance is not considered, and then shrinkflation, which they don't measure, they can't measure that, and extra fees, and say nothing of taxes, which are unbelievable these days. I don't know how the tax increases, happened, but so it's all very scary. And then once you add into the mix the problem that was highlighted 2 days ago, the New York Times, heavily biased and that sort of thing, but the ruling class needs to know the truth, ran a big and absolutely terrifying article about the commercial real estate crisis in big cities in America, which they blamed on the pandemic, which I would blame on the lockdowns or just blame on technological change. But businesses are not leasing the same amount of space as they did before. And they described it as something like a fire sale, like in the scene from Margin Call, right? I mean, where if you're the first one out the door, you're not panicking. And the big banks are offloading these gigantic skyscrapers as fast as they can to any willing buyer. It's like, so are these skyscrapers the new mortgage-backed security? I don't know, but I will tell you that for the article, they could not get either Citibank or Goldman Sachs to go on record to say anything about it. The article ended up with an ominous comment that something along the lines of people have no idea what's about to happen.
Banks are better than private equity at this, or do you think that banks are just quicker to run from risk? And the reason I ask that is I have a friend who is, and then I've got a follow up to this, but I have a friend who's involved in this sort of office area. He's involved in the leasing, and he works for a fund that purchases a lot of these buildings, purchases the management contracts for these buildings. And he was bragging to me post-pandemic, bragging sounds so negative, but I didn't take it that way, that they were buying these just choice buildings in a very large city for 40, 60 cents on the dollar from banks. Mm-hmm. And then I keep seeing this and I'm like, well, that assumes they can't go to 20 or 30 or 10 cents on the dollar in the future. Yeah. Are banks just smarter or more risk averse, or both?
Well, they need to reduce their exposure because they're exposed in every direction. Private equity may not be as exposed, but the big banks are exposed in so many different directions at this point that they probably need to just reduce their risk. So anyway, it's like a cloud no bigger than a man's hand, as they say. It's pretty scary. And I've been anticipating this for 2 years, so I've kind of alert to it. We still don't have office occupancy anywhere near what that was being predicted. After the lockdowns, and they said, "Oh, everybody's going to come back to the office and things are going to be just the way they were." Well, that's not true.
It's not even close.
Nowadays, for any big city job, the fringe benefit everybody wants is not family leave or fancy medical crap. What they want is a hybrid work models where you get you can work from home on Monday and Friday. That's what everybody wants. They're willing to go in on Wednesday and Thursday, maybe, or Tuesday and Wednesday, but you can't get employees to show up anymore. So under those conditions, you're going to reduce these companies are going to reduce their footprint, dramatically, which means they're renegotiating rents, and that's less revenue to service the loans and all these places are highly levered. And, in the end, it's the banks that are holding the bag. It's one thing if the bank ends up holding, a block of homes in, on a Florida subdivision, mm-hmm. like happened in 2008. Somebody else when it's, a row of skyscrapers in Manhattan.
Yeah, I had another friend in a larger Midwestern town, same thing, works for a different private equity. They were trying to convert an office space. I want to say it was Kansas City, but I'm not positive about that, to residential. They were willing to buy it, absorb it. And the municipality was like, no, that's a different tax structure for us. And Oracle it was Oracle that owned the building. They have this 100% empty building that they continue to pay their level of taxes on, which the repurposed building wouldn't account for. At some point, they just walked away and took a hit. So the municipality went from that tax base to zero.
Well, this is what also lay people don't understand. I mean, the very first response is, "Oh, that's not a problem. We've got a housing shortage. We'll just convert all these buildings to residences." But there are the zoning issues at work. But more than that, almost every major tall building built since certainly since 1960 has been built with the presumption that they're all going to be air conditioned. So they have very wide footprints on them. Okay, so the problem is that you can't really carve out anywhere down the middle of these things to say, okay, these are new apartments, because absolutely there's no living soul who wants to live in a place without a window. And that's, a third of the space in these skyscrapers are windowless, which is, wouldn't normally bother you in a regular office building, but you can't do that for residences. So in order to convert these places, you have to cut a big hole down, 100 floors, 120 floors or whatever, right down the middle, and create an atrium with, green plants growing. Okay, once you do that, the pricing structure requires that they be luxury apartments. These are not going to be, housing migrants, and so you have to run the numbers. And it turns out it doesn't really work. You're as you say, you're much better off, walking away from them. Almost every large city built in the last these large structures built in the last 60 years are not easily converted. So it's not so simple.
So I want to ask you about shrinkflation, because people throw that word around, and I think that probably 80% of our viewers know what you're talking about with shrinkflation. But number one, can you explain that first? And then, is there an opposite to that? And what I mean by that is, prior to car prices, prior to it becoming like $1 million for an entry-level car, which is what it is now, it's gone completely nuts. People were saying, well, yeah, cars are a little bit more, but you're getting navigation and rear cameras and all these things where you've got more in for what you bought, more value for the money. So what is shrinkflation, and is there an opposing view to that in the other direction?
Just about everything. I mean, it's not the car less so, but anything you buy at the store, chips bags are going to have far fewer chips now than they used to. One of my favorite examples I noticed just 2 years ago, in holiday cheese balls. I love those cheese balls you get at holidays. They used to be about the size of a softball.
Yeah.
Now they're closer to being the size of a golf ball. I think, what the hell? Same price, but now you get a golf.
Yeah, I noticed that with the Cadbury Easter eggs. I noticed the same thing.
It's just everything's. And yeah, we all need to eat less, whatever. But it's a way of disguising the inflation, and it's much easier with online ordering because you can't tell the size of anything anyway on Amazon. I don't know if you've ever had that happen to you, but you order
always.
Something that's like, this much.
It actually happened I still write things down. It actually happened when I got this pad. I thought it was like a legal size pad, and I'm like, well, I guess I can write small. It's fine.
Yeah. That's really funny. Yeah, so it's very frustrating. And I got curious about this, whether the Bureau of Labor Statistics actually accounts for shrinkflation. On one hand, the Bureau of Labor Statistics says, oh, yeah, sure we do. We really try to account for shrinkflation. But then I read several academic articles on the topic, and they said, they can't account for shrinkflation. That's ridiculous. And they have a hard enough time counting anything at all. What are they telling you? So who are you going to believe? I think we know. And it's affecting other things. Like the Big Mac today is a very different sandwich from what it was 5 years ago.
100%. So is the Whopper.
The other night I was at the
you have to be like my age or older to know that?
Yeah, that's right. I was at a campground the other day, and they had a taco truck, and I thought, well, I'll get some tacos. And the guy in front of me had, bought 2 tacos for $10. And I looked at him, I thought, that's really small. So I said, I'll take 4. So I spent, it ended up being like $22. So, and I took them back to eat them, and I went, and I suddenly had the sense I hadn't eaten anything. I mean, it wasn't even real. It's like a joke. So I had to go back to a different place as I bought a pizza. I was starving. So I said, well, I'll take a full pizza. Well, okay, it's $25. Well, it turned out to be a personal pizza. I mean, it's like this big.
Okay, so it's funny. People think that's a New York thing. I'm in Southwest Florida. Okay, and I literally bought a $3.50 taco this big the other day. Now look at my hand. Look at my hand.
Yeah.
Right. So I went chomp, chomp. I guess I need 3 more of these things.
I know.
I mean, it's nuts.
Oh, I'll tell you another way in which shrinkflation affects us. I was at a fancy restaurant the other night, and I got a Mediterranean white prawn panzella, something like that, with cherry tomatoes and avocados. I thought, well, that sounds delicious. Well, it comes, and it's this huge mountain of croutons with a couple of cherry tomatoes strewn here and there. And balanced carefully on top of this mountain of croutons was 4 relatively small pieces of shrimp. This meal was $40. So this is like $10 a shrimp. And again, I'm not blaming the enterprises.
No,
God knows. But
of course not. I think what drives me crazy, and I'd love your comment on this, try to say on the show all the time that we don't talk about politics, we talk about policy. And one of the policies that's always driven me crazy, simply because politicians on both sides, very few of them have ever run a business. More so on the left than the right, but I don't really care about that. And when you hear about price gouging when prices are going up, and now he wants to legislate against shrinkflation, well, that's just going to make prices higher because they're going to make them add more chips in the bag, and they're going to raise the price. So it's just stupid. But one of the things that drives me crazy is this idea of price gouging. If, for example, a company says, we need a 1% net margin. And so their revenues go from, let's say, $1,000 a year, where they make $10. Prices double. So now it's $2,000, and they make $20. And everybody talks about how they're making such a profit when it's still 1%.
Right.
Am I off using that example, number one? And is this just politics as usual? People don't understand that things actually have input costs.
There's a popular presumption that if money is changing hands, then somebody's making bank. This is generally true. I mean, this is what people think. If I'm giving you money, then you've made money. That is all contingent upon your cost profile and your prevailing margins. And this has a profound effect on the way inflation ends up presenting itself. And I'll just give you an example. So you'll notice that the prices at the liquor store for wine, beer, and liquor are not up that much over 4 years, which is very strange. I mean, they're up maybe 10% overall. But actually, you go to the liquor store, you're like, well, those prices seem pretty reasonable, compared. And like, why is that? Well, the reason is that the margins, the profit margins on wine, beer, and liquor at the liquor store have always been extremely high. They're still facing all the increase in costs that they used to face, but they're able to absorb them more readily. There's a reason why, at least in where I live, there's a liquor store every 2 blocks, because they're very lucrative. The reason they're lucrative is that the margins are so high, so they didn't have to raise prices as heavily on the consumer end. Now, that has a very interesting effect on restaurants, because now they also have to buy, just like consumers go to the liquor store, restaurants go to liquor stores. So they're able to buy low. Now the question is, can they sell high? And the answer is yes. When you go to the pizza parlor, you're like, give me a beer. Well, your beer used to cost $3 or $4. Now it costs $8 or $10. It's like, why is it? I ordered a glass of wine at a resort area the other day, and I said, well, tonight we have the monsieur de pop de beer. I was like, okay, whatever, I'll take it. And well, it was $25
for a glass.
Yeah, for a little, and he poured it in like he was pouring it like it was liquid gold. Like, oh, here's your fancy wine. I was like, shit, $25. Well, the reason for this is that the elasticities of demand are actually extremely high for liquor at restaurants, because people just cannot imagine ordering, a pizza without a beer, or, not getting their cocktail before dinner, or a glass of wine with dinner, the white wine with fish or whatever. That's just normal. And so you're less price sensitive about that. And you think about it, when you go into the restaurant and say, well, I'll take a dry martini Well, you don't say, how much are your martini? Like, nobody says that. How much are your martinis here? You just don't. You just say, I want a martini. You don't say, how much martini? Oh, no, thanks. I'll just stick with water. Like, that never happens.
Never happens.
Restaurants know this, and so they're packing in all their profit margins into their liquor sales and wine sales and beer sales. This is what's happening.
I had a friend of mine in that business, and he told me liquor is recession-proof. He said during COVID, when they shut all the businesses down, they left the liquor stores open.
Oh yeah, and I talked to
could not have been more busy.
I talked to a public health official at the time, and I said, "Why is this?" She said, "Because if we closed the liquor stores, everybody would have killed each other."
Yeah, well, that's great. So, how does this apply to markets? Because I think that this still feels eerily like the 2000s to me, especially as the breadth of the market shrinks right into these few companies that are doing so much better than all the rest.
Yeah.
And while I see indications that we're in a reflationary environment, both from a stock market perspective and a pricing perspective,
sure,
wages are still rising somewhere in the range of 3.5%-4% annualized. So, but for some reason, it's not spread across, especially when you're looking at consumer names and things like that. So in the overall market view, how does your recent research touch on that at all? Do you think the consumer is just going to say, I give at some point? Because I do.
I think this is happening now. And if you look at household finances, you see record credit card debt and with record numbers of revolving accounts that are being charged 20 and 23% interest. It's insane. And personal savings rates, which I do trust this data, by the way, because they're like real and they're reported by the banks. Personal savings rates are dropping below 3%. So wow. That's just like next level. This puppy knows exactly what time it is, and he knows it's time to eat. So I may have to hop off.
That's all right, Jeff. I really appreciate it.
And he's impervious to the inflation that it has to feed him.
I'm surprised you can't hear my dog snoring here on the right. Look, I appreciate you taking the time. I know we kind of caught you by surprise, and then Jimmy had to bump off. But tell everyone, first of all, how they find you, and then how they can find this new piece that just came out.
Yeah, I haven't seen it yet, but I got a notification that it appeared on Brownstone.org. I'm kind of excited about it because I think this is the first article. I talked to a major economist at a major bank the other day because I laid this out to him on the phone, and he said, "Well, all that sounds correct." And I said, "Well, how come you haven't said that?" He said, "You can't say those things. You just can't. You can't say those things." So
I personally want to thank you for what you do, Jeff, and I really like Peter too. You said the article's in conjunction with Peter.
Yeah, he's a great guy, and I appreciate him for co-authoring with me because he is a truth teller. And we live in times where people are not telling the truth, sadly. And
that's kind of important for you to plan your life out.
We do what we can. But anyway, I'm going to
president, founder, Brownstone Institute. That's his puppy who's hungry.
That's right.
And as Jim always says, remember why we do this. Jim and I got booted out of traditional media. So now I get to show my tattoos and talk to people we like and say what I want. So thank you guys so much for watching. Jeff, thank you so much again. I really appreciate it.
Such a pleasure. All the best. Bye-bye.